I want to start with a number, 863 tons. That is how much gold the world's national banks, called central banks, bought together in 2025 alone. Not just one bank, not just one part of the world. The central banks of the entire world, each making their own decisions, but all doing the same thing at the same time, bought 863 tons of gold in a single year. To understand how big that is, the average amount of gold central banks bought each year between 2010 and 2021 was 473 tons. In other words, the organizations that create and manage the world's paper money, the very groups whose power depends on people continuing to trust that paper money has value, more than doubled how fast they were collecting the one thing that has always, throughout all of history, been the natural replacement for paper money, and 95% of all central banks that were asked in a survey say they expect countries around the world to hold even more gold over the next 12 months. I want you to stop and think about that for a moment, because I believe that if most people in the Western world truly understood what that signal means, truly thought through what it means that the very organizations that print money are rushing to own the thing that exists precisely because printed money can fail, they would feel a sharp, cold, and urgent sense of clarity about the financial moment we are all living through right now. I have spent 50 years as a global investor studying how money and economies work all around the world. I have studied how money systems have worked going back 500 years, and I have never seen a signal this large, this steady, and this globally agreed upon from the very guardians of the paper money system. This is not guesswork. This is not fear. This is the people who know the system best telling you, through what they are doing, not what they are saying, exactly what they believe is coming. This is what I mean when I say there is a global gold rush happening right now, and I am here to tell you with every bit of certainty that 50 years of studying financial history can give a person that the Western economy is going to be hit by this gold rush harder than almost anyone is currently ready for. Not because gold itself will hurt the Western economy, but because the conditions that are driving the gold rush, the debt, the loss of money's value, the breaking apart of the financial system that was built after World War II, the use of money as a weapon between countries, and the collapse of the simple investing rule that Western investors have trusted for a generation. Those conditions are hitting the Western financial system with a special and particular force. The gold rush is not just a sign of what is happening, it is a mirror, and what it is showing the Western economy is not a pretty picture. Let me tell the story from the beginning, because the full weight of what is happening only becomes clear when you understand how we got here. For many decades, especially after the financial crisis of 2008, Western central banks followed a policy of making money very easy and cheap to borrow. Interest rates were kept near zero and sometimes even below zero for years at a time. Programs called quantitative easing pumped trillions of dollars, euros, pounds, and yen into the financial system. Governments kept spending more than they earned, borrowing money at artificially low rates and piling up debt at a speed that would have been considered reckless and irresponsible by any earlier standard of good financial management. And for a long time, this seemed to work. The prices of things people owned, like houses and stocks, went up. Economies grew. Inflation, meaning the rising cost of everyday things, stayed low, which genuinely surprised many economists. The accepted belief slowly hardened into something that felt like certainty. You could print money forever, pile up debt without end, and somehow the bad consequences that history had always shown would follow such behavior simply would not arrive this time. I never believed that. I have always believed, because history makes it absolutely clear on this point, that there is no such thing as getting something for nothing when it comes to money. Every dollar printed makes every dollar that already exists worth a little less. Every loan a government takes out is a promise to pay back money from future work that may or may not actually happen. Every year that debt grows faster than the economy that has to pay it off is 1 year closer to the moment when the math finally catches up. Delaying that moment by manipulating the money system does not make the debt go away. It makes it grow. It moves the problem from today to tomorrow, and it packs on interest, rising prices, and built-up weakness in the system along the way. And when tomorrow finally comes, as it always does, the weight that has to be carried is heavier for every year it was put off. That tomorrow is now arriving. And the gold rush is the clearest and most undeniable proof that the world's most knowledgeable and serious investors, the central banks, the giant national investment funds, the pension managers, and the big macro investment funds have recognized that the era of printing money without consequences is over. Let me be specific about why this hits the Western economy with particular force. The United States, the United Kingdom, the countries of the Eurozone, Japan, these are the economies that pushed the hardest on easy money policies after 2008. These are the economies carrying the heaviest loads of debt compared to how much they actually produce. The United States alone carries $38 trillion in national debt. Total debt across all parts of the global economy reached $340 trillion by mid-2025, 3 to 4 times the total value of everything the entire world produces in a year. These are levels of debt that have never existed before in the history of the modern financial system. And critically, these are the economies whose money, the dollar, the euro, the pound, serves as the world's main reserve currency. That means when those currencies lose their value, it does not just hurt people living in those countries, it ripples through the entire global money system. Here is the key thing that Western investors are almost entirely missing. When central banks around the world buy gold, when Poland adds 102 tons to its reserves, when Brazil adds 43, when Kazakhstan adds 57, when country after country in the developing world speeds up its gold buying, they are not doing it simply because they think gold's price will go up. They are moving their savings away from Western government debt and Western currencies. Every ton of gold that goes into a central bank's vault is a ton of savings that is not being held in U.S. Treasury bonds, not being held in German government bonds, not being held in UK government bonds. It is a deliberate choice by a country's finance leaders that the value of holding promises from Western governments has gone down compared to holding a physical thing, gold, that carries no risk of a partner failing you and that no government can make worth less simply by printing more of it. And here is what that means in real life for the Western countries whose debt these central banks are no longer buying. When fewer central banks around the world want to buy Western government debt, when the pool of buyers shrinks and the same amount of bonds has to be bought by a smaller market, interest rates on those bonds have to go up to attract the buyers who are still there. Higher interest rates mean higher borrowing costs for governments that are already running trillion-dollar yearly deficits. Higher borrowing costs for the government mean bigger deficits because the cost of interest grows, which means more bonds have to be sold, which means interest rates have to go even higher to attract buyers for all those extra bonds. This is the doom loop I have described. This is the debt spiral that feeds itself once it gets going. And the global gold rush, by pulling big investors away from Western government bonds, is quietly and steadily tightening the grip of this spiral. Now, I want to address something that I know many Western investors believe, even if they would not quite say it this directly. They believe, or at least hope, that the Federal Reserve, the European Central Bank, and the Bank of England will simply step in, will simply buy whatever bonds the regular market will not buy, will simply create enough new money to keep interest rates low and the system working. I want to be honest with you about what I believe on this question, because it is the central issue on which the entire argument rests. The answer is yes, they can do this. Central banks have basically unlimited ability to create new money and use it to buy government bonds. There is no technical barrier to printing money forever to pay for government spending, but there is a consequence, and that consequence is exactly what is driving the gold rush. When a central bank prints money to buy government bonds, it expands the supply of money. More money in the system, all else being equal, tends to cause prices to go up. That is inflation. Inflation eats away at the buying power of every unit of money that exists. It is a hidden tax on savings, on wages, on anything measured in that currency. And in a world where the organizations that create money are being watched by the rest of the world more closely than ever before, where foreign central banks are tracking every policy decision, every expansion of a country's money supply, every sign that financial discipline has been permanently abandoned, the act of printing money to pay for government spending sends a signal that speeds up the very rush away from that currency that the printing was supposed to prevent. It is a trap, and Western money authorities are, to varying degrees, already inside it. The biggest yearly gain for gold since 1979 happened in 2025, when the metal returned 65% measured in dollars, the strongest year for gold in almost half a century. And I want to be very direct about what I believe that signal means. The gold surge in 1979 happened against the backdrop of the highest peacetime inflation in American history, a serious loss of trust in the Federal Reserve's ability and independence, and an extremely stressful situation in world politics. The current gold surge, the gold rush that is reshaping how countries hold their savings right now, is happening against a backdrop that I believe is structurally more difficult than 1979 in several important ways. In 1979, the debt load was manageable. In 1979, Federal Reserve Chairman Paul Volcker could raise interest rates all the way to 20% and break the cycle of inflation through sheer financial discipline, accepting a painful recession as the price of restoring trust. Could a central bank do that today, with $38 trillion in government debt, with business debt at all-time highs, with the housing market depending on relatively low long-term interest rates? The answer is almost certainly no. The ability to use the 1979 solution has been used up by 40 years of piling on more debt, and that is exactly why the current gold rush is more structurally important than anything that happened in 1979. Let me now address the specific way in which the Western economy is uniquely exposed, not just financially but in terms of how its institutions work, to the consequences of the global gold rush. For decades, the most popular investing strategy for Western institutions has been the 60-40 portfolio, 60% stocks, 40% bonds. The idea was simple and had worked well historically. When stocks fell, bonds went up, cushioning the blow. When bonds fell, stocks usually did well, reflecting the economic growth that makes stocks valuable in the first place. The two types of assets moved in opposite directions. They were negatively correlated, and this opposite movement meant that a portfolio split between them was more stable than either one alone, offering what I have always called the closest thing to a free lunch in investing: the benefits of spreading out your risk without giving up returns. That framework is breaking down, and the global gold rush is both a sign and a cause of that breakdown. What has happened in recent years is that stocks and bonds have started moving in the same direction, both falling during periods of inflation-driven downturns, both rising during periods of easy money policies. The opposite movement that made the 60-40 portfolio work has collapsed to the lowest levels in 30 years during stressful times. This is not a temporary glitch. It is a structural result of the money environment we are in, when inflation is the main risk, when the threat is not an economic slowdown but the destruction of your money's buying power. Both stocks and bonds suffer at the same time, because both are assets measured in paper money whose real value shrinks as prices go up. The protection that Western pension funds, national investment funds, and regular investors have relied on for decades is disappearing exactly at the moment when they need it most. And here is where the gold rush becomes not just a financial event but a deep structural challenge for the Western economy. The organizations that manage Western retirement savings and the pension funds, insurance companies, and endowments have been holding far too little gold by the standards of what history suggests is wise in an environment like this. Most Western pension funds hold less than 2% of their money in gold. Many hold none at all. I have consistently recommended that investors hold between 10% and 15% of their portfolios in gold, not as a bet or a gamble, but as the strategic insurance that every portfolio needs against the specific risks that are most elevated right now. The gap between where Western institution portfolios currently sit on gold and where they should sit for proper protection is enormous. And as that gap starts to close, as the pension funds, endowments, and family investment offices that have been slow to respond to the gold signal start to catch up to what central banks have been doing for years, the demand pressure on gold will grow even stronger, and the movement of money away from Western government bonds and into real physical assets will speed up. I want to talk about what this looks like in real terms for ordinary Western citizens, because the gold rush is not just a story about big institutional portfolios and national savings management. It is a story about the daily financial lives of hundreds of millions of people in the United States, in Europe, in the United Kingdom, People who are already feeling the consequences of the money environment that is driving the gold rush, even if they do not recognize the connection. Since 2020, American consumers have lost nearly 20% of their buying power, as measured by the Bureau of Labor Statistics. That is not an abstract number on a spreadsheet. That is groceries costing 20% more, rent rising by 30%, 40%, or 50% in many cities. Healthcare, childcare, education, the most important categories of what families spend money on, all becoming harder to afford compared to wages that have not kept up. This is what it looks like when money loses its value from the inside. Not a dramatic collapse, not newspaper headlines about hyperinflation, just the quiet, steady erosion of what your money can buy year after year in ways that the official numbers do not fully capture and that no central bank press release will ever honestly describe. The people who feel this most sharply are those in the bottom 60% of earners, the people who do not own significant financial assets, who cannot easily spread their money into gold or international stocks, who keep their savings in bank accounts and government bonds that are being silently taxed by rising prices. This is why I have said clearly that the buying power of money is the defining political issue of our time. It is not abstract. It is personal. It is felt at the grocery checkout, at the leasing office, at the gas pump, and it will produce political consequences. It already is producing political consequences that themselves create further financial instability in a feedback loop. That is one of the most dangerous patterns I have observed in my 50 years of studying these systems. Now let me address the question that I know is on many people's minds. Is the gold rush simply a bubble? Is it just speculation? Is the extraordinary rise in price, with gold hitting all-time highs repeatedly, and major investment banks from Goldman Sachs to JP Morgan to UBS all projecting prices of $5,000, $6,000, even $6,300 per ounce before the end of 2026, is any of this sustainable? My answer to that question is grounded not in feeling or guesswork, but in the structural forces I have been describing. The gold rush is not primarily driven by ordinary people speculating. It is not a meme stock moment. It is not a momentum trade that will reverse when people's moods change. The core driving force is institutional. It is central banks. It is national wealth funds. It is the most sophisticated and careful investors on earth making long-term structural decisions about how to hold their national savings in response to the very real and very measurable breakdown of the money system that I have been warning about. When the National Bank of Poland, not a reckless developing country institution but the central bank of a member of both NATO and the European Union, announces that it intends to grow its gold reserves to 700 tons for what its governor openly described as national security reasons, that is not a speculative trade. That is a permanent structural decision by a major institution about how it wants to hold its country's wealth in a world it no longer fully trusts to follow the rules and commitments that were assumed when those savings were originally stored in dollar-based assets. When 95% of the world's central banks tell the World Gold Council that they expect global gold reserves to increase, that is not a bubble indicator. That is a structural demand signal of extraordinary staying power. And the supply side of the equation makes the demand picture even more compelling. Gold cannot be printed. It cannot be called into existence by a government order or a central bank expanding its balance sheet. The total amount of gold above ground grows at approximately 1% to 2% per year through mining. That is a slow, limited, geologically constrained process. When institutional demand doubles compared to its historical average, while supply grows at only 1% to 2% per year, the math of price discovery is not complicated. It points in one direction, and that direction is what JP Morgan means when it projects $6,300 per ounce by year's end. What Goldman Sachs means when it projects $5,400, what the World Bank means when it says precious metals are projected to reach new all-time highs in 2026, following what was already the strongest yearly gain since the late 1970s. I want to be clear about what I am not saying. I am not saying that everyone should sell all their other assets and put everything into gold. I have never said that. My recommendation has been, and still is, that most investors should hold between 5% and 15% of their portfolios in gold or in what I call alternative money. assets that work like gold in their ability to protect buying power when the money system is under stress. The exact percentage depends on your own situation, your comfort with risk, how long you plan to invest, and what else is already in your portfolio. But I want to be equally clear about what I am saying. In the current environment, with Western government debt at levels that cannot be sustained, with central banks printing money to pay for government spending, with the post-World War II money system cracking in ways not seen since the 1930s, with the global gold rush reflecting the careful, considered judgment of the world's most sophisticated institutional investors, the risk of holding too little gold in a Western investment portfolio is far greater than the risk of holding too much. The question I am asked most often in every interview and every discussion where I talk about these issues is this: if the situation is so serious, why haven't bond markets already broken down? Why hasn't the dollar already collapsed? Why are Western stock markets not already falling sharply to reflect the structural problems you describe? And my answer to that question is always the same. Because these transitions happen slowly, because the momentum of the existing system is enormous, because reserve currency status, once established, takes decades to meaningfully erode, even when the underlying facts no longer support it, because the absence of a ready alternative to the dollar, the euro being split by different countries' fiscal situations, the Chinese yuan being limited by capital controls, gold being too small in scale to fully replace paper currency, means the world continues to use the dollar out of necessity, even as trust in it declines. The transition I am describing is not a crash. It is an erosion, a slow, persistent, sometimes speeding up, occasionally pausing erosion of confidence and dominance that ultimately, when it crosses a threshold, produces outcomes that feel sudden, even though they were decades in the making. Ernest Hemingway described bankruptcy as happening slowly, then all at once. I have borrowed that description many times because I believe it perfectly captures how monetary transitions unfold. The slow part is underway. It has been underway for years. The gold rush is one of the clearest and most measurable signs of that slow part. And the question that every Western investor needs to be asking themselves right now is not whether the transition is happening. The data is clear and undeniable. The question is where they stand in their own preparation. Whether they are positioned for the slow part to eventually become the fast part, or whether they are waiting, as so many have waited before them in similar moments in history, for an official announcement of a crisis that by its very nature will never come until it is far too late to act on it. I have seen this pattern in the historical record so many times that it is almost numbing. The people who came through the great monetary transitions of the 20th century with their wealth intact were not the most optimistic. They were not the ones who trusted that the system would always find a way to manage its own contradictions forever. They were the ones who read the signals, understood the mechanisms, felt the weight of the numbers, and moved their portfolios toward real assets and genuine diversification before the majority recognized what was coming. They held gold when gold was out of fashion. They diversified away from their home currency when their neighbors thought such caution was unnecessary. They accepted lower returns on paper in exchange for genuine protection of their buying power. And when the transitions came, and they always came, those investors did not just survive. They were positioned to thrive because the assets they held grew in real value precisely during the periods when everything else was being made less valuable by money printing. The global gold rush unfolding right now is the largest and most globally synchronized signal of that kind that I've seen in my entire career. 863 tons purchased in a single year, 95% of central banks planning to accumulate even more, major investment banks projecting gold at $6,000 and beyond, the strongest yearly gold performance in 46 years, gold already recognized by the International Monetary Fund as the world's second largest reserve currency. Every one of these data points taken individually is significant. Taken together, they form what I can only describe as a historic warning, the financial equivalent of every earthquake detector on Earth registering a tremor at the same time, each one operated by some of the most sophisticated institutions in the world. The Western economy will feel this more sharply than any other part of the world, for the simple reason that the Western money system, the dollar, the euro, the pound, sits at the center of what is being questioned. The debt that is driving the distrust is Western debt. The currencies being moved out of national savings portfolios are Western currencies. The bonds that are no longer being bought at the rates needed to keep Western governments' finances on track are Western bonds. The investors who are most underprotected in gold relative to where they should be, given what the institutional world is signaling, are overwhelmingly Western investors, people who have been told for decades that bonds are safe, that the 60-40 portfolio is the answer, that spreading risk means owning different sectors of the American stock market, rather than genuinely different types of assets with genuinely different risk profiles. The gold rush will hit the Western economy harder than you think. Not because gold is an enemy, but because gold is a truth teller. It goes up when paper money goes down. It goes up when trust in the money system erodes. It goes up when the institutions that create money are forced to show through their actions, if not their words, that the paper they produce is not as reliable a store of value as the physical thing they are buying to protect themselves. And right now, it is going up with a force, a breadth, and an institutional depth that I have not seen in my lifetime. The signal could not be clearer. The question is whether the Western investor, the person who has built their financial life around assumptions about monetary stability, bond safety, and dollar dominance that are quietly but measurably being revised by every central bank on earth, will understand that signal in time to act on it. The gold rush is here. The Western economy is at the center of what is driving it, and the investors who understand that connection, who recognize that the rush for gold is not a bet on gold, but a bet against the long-term reliability of the money system that Western economies have built, and a hedge against the consequences of its gradual unraveling, will be the ones who look back on this moment as the time when clarity was available to those who were willing to look clearly.